Stocks once again on the upside today, the Dow pushing ever higher into record territory. That, of course, on the back of yesterday's triple-digit gain. And as the Democratic-controlled Congress considers raising taxes on private equity and on hedge funds, a lot of people wonder whether the rally will continue or might those tax hikes kill the bull market run. Joining me now from Allentown, Pennsylvania is Pat Toomey, president of Club for Growth, and from Washington, Jason Furman of Brookings Institution and former Clinton economic advisor. Gentlemen, welcome. Nice to have you here.
Good morning.
Pat, I'll start with you. You think if indeed these tax hikes or the changes in the tax structure go through, that it could indeed kill the bull. Tell me why.
Well, absolutely. Obviously, taxes are a burden on an economy, and they're a burden on a market. What we're seeing from the Democrats is a broad-based attack on capital formation. That would be terrible for the markets and terrible for our economy. And the thing that's just so perplexing about it is the enormous success we've had since the 2003 supply-side broad-based tax cuts. We've had a near-record economic expansion, unemployment that's averaged lower than the last 3 decades, record new home ownership, record family wealth, record highs in the stock market. All the while, we've had low interest rates and a disappearing deficit. So why would you go out and raise taxes in this environment? It'd be terrible.
Jason?
Well, I don't think there's any evidence that the 2003 tax cuts caused what's happened in the stock market since then. So making any changes to those wouldn't hurt the stock market either. Some economists at the Federal Reserve did a study, and they compared the U.S. market to the European market, found the European market did just as well at roughly the same time that the U.S. market did. This is a global recovery. It's good news, but it's not due to the Bush tax cuts.
Jason, what about those who say that if indeed the tax structure is changed for either private equity or for hedge funds, that it hurts the competitive nature of those industries here in the United States and would shift them to the likes of London, which has already captured, you know, the king of the IPO title?
Well, first of all, London is considering a lot of the same changes. I think the most important question is one of tax policy. It's not whether you want high taxes, low taxes, more progressive, less progressive. A lot of people disagree on all of those issues. The one thing every economist agrees on, though, is that the tax code should be neutral, and it should treat similar activities similarly and tax them the same. So then you have to ask yourself a question. A private equity manager, is that performance-based compensation, in which case it should be taxed just like ordinary income, or is it akin to starting a small business, putting some of your sweat equity in it, and selling the business when it does well?
Pat, that sounds, you know, pretty basic. What do you think?
Well, let's look at where this income comes from. The income, for whether it's a hedge fund manager or a private equity manager, it's from an appreciation in the value of assets. And we have long settled law in this country that an appreciated value of assets is a capital gain. And we allow partners who are participating in that to divide that up as they see fit. We should not convert that to an income tax because some people have been very successful. And let's also keep in mind that all the companies that these private equity funds are investing in, they're paying full ordinary taxes as every other corporation does. And the other thing that we really should never lose sight of, we can go ahead and slap a new huge tax increase on this industry, and you know who's going to suffer? It's going to be the people who've done so well investing with private equity funds, the pension funds, foundations, universities who've gotten outsized returns in recent years. Well, those returns are going to diminish if there's a whole big new tax on this industry.
Jason, you get the final word. What about that?
The investors in private equity or hedge funds would be entirely unaffected by any change in the tax rule. All we're asking is the question, do you think this is compensation? And a lot of compensation, CEOs get it in the form of stock options, mutual fund managers get it related to the performance of their mutual funds. They pay income taxes. Is it compensation? If so, income taxes. Is it appreciation in capital from your business? If so, capital gains. You need to figure that question out, but it's not going to tank the stock market either way. The stock market will do just fine.
On that note, gentlemen, thank you both. Pat, Jason, nice to have you with us.
Thanks for having me.